Investment portfolio. A portfolio is a word that might evoke images of a business person's briefcase full of important documents. In investing, this word has a slightly different meaning, but the concept is similar. An investment portfolio is a kind of bag that contains all your financial assets. These can be stocks, bonds, real estate, funds, and even some cash. A portfolio helps an investor allocate their money across different assets to reduce risks and increase the chances of success. What is an investment portfolio? An investment portfolio is the sum of all assets that belong to an investor. These can include financial instruments such as stocks and bonds, as well as more tangible things like real estate or artwork. The key to a portfolio is balance. No matter how tempting it may seem to invest all your money in the stocks of one popular company, it always comes with high risks. That's why investors build their portfolios to ensure that if one part of the assets loses value, others can compensate for those losses. Example: imagine you invested all your money into the stocks of one tech company, say Amazon. If that company suddenly faces difficulties and its stock price drops, you will lose a significant portion of your money. However, if your portfolio includes not only Amazon stocks but also bonds, real estate, and shares of other companies, your losses will be much smaller. That's why it's important to have a diversified portfolio. Types of portfolios. There are many different types of investment portfolios, each suited to different goals and types of investors. Let's look at the main ones. First, aggressive portfolio. An aggressive portfolio consists of assets with a high level of risk, but also the potential for high returns. Such a portfolio typically includes shares of fast-growing companies that can bring significant profit, but the likelihood of losses is higher. This type of portfolio is suitable for young investors or those willing to take risks for the possibility of big returns. Example: your aggressive portfolio might include stocks of companies like Tesla or Nvidia. Yes, their shares can increase sharply in a short period, but they can also drop if something goes wrong. However, if you manage to buy them at a low price and wait for growth, the returns can be very impressive. Second, conservative portfolio. A conservative portfolio, on the other hand, focuses on minimizing risk. The main assets here are bonds, which provide a stable, albeit not very high, income. This portfolio is for those who are not chasing big money, but prefer stability and predictability. Conservative investors often choose this type of portfolio as they approach retirement or want to preserve what they have accumulated. Example: your conservative portfolio might consist of government bonds and bonds from large companies like Microsoft. The returns won't be high, but your money will be safe, and you can count on stable interest payments. Third, balanced portfolio. A balanced portfolio combines elements of both aggressive and conservative approaches. It includes stocks that can provide high returns and bonds that offer stability and risk protection. It's a kind of golden mean, suited for investors who want to take some risks, but also aim to preserve their capital. Example: a balanced portfolio might include shares of companies like Apple and Google, as well as bonds from major corporations or government securities. This type of portfolio gives you the opportunity to profit from stock growth while reducing risks through bonds. Fourth, dividend portfolio. A dividend portfolio focuses on generating stable income from dividends, regular payments that companies make to their shareholders from profits. Investors who choose this type of portfolio are typically aiming for passive income that regularly flows into their accounts. Example: in your dividend portfolio, you might include shares of companies known for their stable dividend payments, such as Coca-Cola or Procter & Gamble. These companies pay their shareholders regularly, and even if their stock prices don't rise, you still receive income in the form of dividends. Fifth, international portfolio. An international portfolio includes assets from different countries and regions, allowing you to diversify risks and take advantage of growth opportunities in global markets. This approach helps reduce dependency on a single country's economy and take advantage of emerging markets. Example: your international portfolio might include shares of major American companies like Amazon or Facebook, as well as bonds from European or Asian issuers. This allows you to earn income not only from the American market, but also from the growth of other economies. How to build a portfolio. Building a portfolio is a process that requires careful attention and analysis from the investor. It's important not only to choose assets, but also to consider your goals, investment horizon, and the level of risk you're willing to accept. First, define your goals. Think about why you need this portfolio. Do you want to save for retirement, create passive income, or simply grow your capital? Your goals will determine the type of portfolio that suits you. Example: if your goal is to save for retirement, you'll likely be best served by a conservative or balanced portfolio. If you're young and willing to take risks, an aggressive portfolio might be more suitable. Second, assess your risk tolerance. Some investors are willing to endure large market swings for the chance at high returns. Others prefer stability and are satisfied with smaller gains. Your level of risk tolerance will directly affect what assets are in your portfolio. Example: if you're comfortable with your stock prices fluctuating, fast-growing companies like Tesla could be part of your portfolio. If you want to avoid stress, corporate bonds or government bonds might be better suited. Third, diversify. One of the main rules when creating a portfolio is diversification, distributing assets across different categories. This helps reduce risks because if one asset shows negative dynamics, others might compensate for the drop. Example: instead of putting all your money into one company's stock, add bonds, real estate, or even gold to your portfolio. This will help you balance risk and get income from different sources. Fourth, regularly review your portfolio. Financial markets are constantly changing, and what was a good decision a year ago may lose relevance today. Regularly reviewing your portfolio helps the investor make timely adjustments and stay afloat in a changing economic environment. Example: you invested in tech company stocks and they brought you good returns. However, the market has changed, and now it might be worth considering adding bonds or dividend-paying stocks for more balance. How to evaluate portfolio success. Evaluating portfolio success is an important part of the investment process. It's important not only to look at returns but also to consider the risks you've taken. One way to evaluate is to compare your portfolio to benchmark indexes, such as the S&P 500. Example: if your portfolio grew by 10% over the year, but the S&P 500 grew by 15%, this could signal that it's time to review your portfolio. However, if your portfolio is more conservative and includes bonds, such a result might be perfectly acceptable since you took on less risk. Another way to assess success is by reaching your financial goals. If you built a portfolio to generate steady retirement income and it provides you with the desired level of income, then the portfolio can be considered successful. Example: you plan to receive 5% annually from your portfolio and achieve that by holding dividend-paying stocks and bonds. Even if the overall portfolio growth is below the market average, for you, this is a successful outcome because you reached your goal. Conclusion: an investment portfolio is an essential tool for every investor. Whether you are a beginner or an experienced player in the market, properly forming and managing a portfolio allows you not only to preserve, but also grow your investments. Understanding your goals, risk tolerance, and regularly diversifying assets are key steps to success. By creating a balanced portfolio, you will be prepared for any market conditions, because if one part of your assets goes down, others can compensate for the decline. Different types of portfolios, from aggressive to conservative, offer every investor a chance to find their approach, considering their age, life goals, and risk tolerance. However, it's important to remember that investing is a long-term game. Don't panic over temporary market fluctuations or try to earn everything at once. It's better to move steadily toward your financial goals, regularly reviewing and adjusting your portfolio. This way, you can confidently build your future, knowing that your capital is working for you with minimal risk and maximum return. Let your portfolio become your reliable financial companion, supporting you in achieving your goals, whether it's saving for retirement, creating passive income, or growing your capital. Invest wisely, and your investment portfolio will become your faithful ally in the world of finance.